Imminent crisis approaching by the hour. Martin North, John Adams, In the Interest of People. Hello, John.
Hello, sir.
Well, we keep having these shows because things are moving so fast.
Absolutely. So here we are on Thursday morning, recording a new show just after the US Federal Reserve have made their dramatic interest rate decision. And our last show was on Monday. And in the last 3 days, so much has happened that is quite alarming. That it's definitely worth us coming back and sort of doing a new show and actually providing our viewers with it in terms of an update. So just to recap, in terms of where we were on Monday, so we really talked about three types of risks that our audience needs to be aware of, which is inflation risk, credit risk, and liquidity risk. And in the lead up to the US Federal Reserve making their decision at 4 o'clock Australian time this morning, we've seen credit risk and liquidity risk blow up over the last 3 days, which has caused all sorts of consternations across the world, both in the developed economies as well as the developing economies. And so just to give our audience one example of that, let's put our slide one on the screen. Turkish credit default swaps jumped to 19-year high amid lira woes. So this only happened, I think, within 24 hours of our last show. And obviously there was extreme eruptions in the bond market worldwide, and people were concerned, obviously, because the Turkish corporate sector is heavily in debt. There's a lot of concerns about the value of the lira, given the monetary policy of the Turkish central bank. And obviously, you know, when these credit default swaps are jumping up, I mean, these are effectively insurance on Turkish debt, and people were nervous about a default event or a credit default event happening in Turkey. And that's why these Turkish insurance rates went through the roof.
Yeah, and it's interesting, in the press conference that Powell presided over after the announcement, there were a very small number of questions about liquidity and liquidity-related issues, which I found quite surprising, because to me, the liquidity question is almost bigger than the inflation question.
Yes. Well, yes. So there was one journalist who asked about illiquid markets, but that was sort of that was sort of batted away with not a lot of attention. Obviously we've made the point time and time again that this is the biggest debt bubble in the course of human history. But once you have a bubble of this magnitude and you've got rates suppressed so low for so long, once you take your foot off the accelerator just a bit, these things do not unwind very slowly and gradually. They are super quick. Yep. And so I think policymakers have now got the message that there is no, the amount of room that they actually have to adjust policy is so tiny, because if they allow the free market to work again. So from a macroeconomic point of view, if you have so obviously in this situation, interest rates are low, and there's a price floor below equilibrium that these central banks have imposed. So once you say to the market, we're going to take away this price floor, well, the movement towards equilibrium is very quick and rapid. Yep. And that obviously causes huge structural adjustment problems that, as we have just seen in the last 4 days, the Europeans cannot handle.
Now, my analogy is the balloon underwater, right? They've pushed this balloon down underwater, a long way through their various programs, and now they're sort of letting go. And of course, the balloon doesn't gently rise; it goes whoosh, right?
Yes.
And so what they now? Oh no, we'll keep it dry, keep it underwater again, right? But the cost of doing that means more debt.
And more inflation. So they're actually now fighting against the very thing that they were trying to fight on a different back. I mean, they talk about rock and hard place. Yes. So because the Europeans now have surrendered to inflation, I mean that's why we are seeing, for example, the World Bank talk about stagflation in terms of the big way, because obviously the war and all of these rising costs is having a huge issue about the ability to generate economic growth. At the same time, you've got high inflation. and you can't address the inflation because it would cause a worldwide depression. So we'll obviously have that situation there. So now let's go to the United States. So the really interesting thing about what the Americans have done is that now in the first quarter of 2022, the U.S. economy shrank by 1.5%, and a number of market observers has been looking at the Atlanta Fed because they have the official estimate or the forward estimate as to what the second quarter is going to look like. Now, a technical recession is 2 consecutive quarters of negative growth. And so they started off around 2%, then they went down to 1.3%, 0.9%, and just before they met today, they came out with their latest estimate, which was 0.
Yep.
And so let's actually put slide 6 on the screen. And so this is actually straight from the Atlanta Fed's website, where they actually show that their latest forecast for economic growth for quarter 2 is 0. Now, why is it 0? The really interesting aspect of this is that in business investment is going through the floor.
Yep.
And perhaps there's quite a bit to do with the Biden administration but also in terms of particular sectors of the economy that were getting favorable treatment from the Trump administration are no longer getting that favorable treatment, and so that's why business investment is way down. And so what's holding the U.S. economy up? It's actually household consumption,
consumer, yep.
But also in terms of government consumption, and what the U.S. Federal Reserve, the Atlanta Fed, actually showed in their estimates is household and government consumption is actually slowing. At the same time, that business investment actually is falling off a cliff, and so we haven't seen a situation like this. Now, just for historical context, the last time the U.S. Federal Reserve raised interest rates by 0.75 was in 1994, and that triggered a debt crisis in Mexico. And it was only 7 months after that did the U.S. Federal Reserve they were forced to cut again. So we've seen this happen before: you dramatic raise in rates, a debt crisis somewhere in the world who are too indebted, and the U.S. Federal Reserve is forced to reverse course. Now, I think they're going to reverse course faster than in terms of 7 months, but when you have a situation where you have so much household debt driving economic growth, and then you're going to dramatically raise interest rates in that environment, well, those households you're going to see household consumption go through the floor, and then you're going to see economic growth, rather than just be in a small recession, it's going to be a very deep recession. And then we get into this problem, particularly about credit risk, because you're going to see a whole bunch of consumers and corporations that cannot afford these repayments in a high interest rate environment. And then we get back to what we were saying the other day about in terms of the pivot as to, do you continue to address inflation? And as we said, to address inflation, you need to get interest rates above the inflation rate. If inflation is 8.6, we need U.S. interest rates not at 1.5 or 1.75. We need them dramatically higher, potentially at say 9-10%. But they can't take it there. So they're in a real bind. And I think this rising rates dramatically in an economy that is actually tanking and going into recession, it's going to lead to this pivot very soon. And even though the US Federal Reserve didn't give any clear indications that they were concerned about household consumption or economic growth, I think the facade they were pushing today is going to evaporate extremely quickly.
And it's interesting, the same day as the rate announcement, there was a retail sales data which was below expectations. So the markets were expecting a small rise. It actually was a little bit of a fall. So maybe retail sector is actually already falling. So
and I have to say that as we get closer to November in terms of the midterm elections, I mean this is going to be a political disaster for Biden in terms of the U.S. Democrats, because where you have a situation where people are suffering because of inflation, and now they're being required to stump up an extra $160 billion in terms of, well, actually, technically speaking, it's probably north of $200 billion. If you think over the last few months, they've raised rates by 1.5% over three meetings. So that's north of $200 billion of additional interest that households are being expected to pay, and a lot of households just don't have that money to pay. So we're going to see consumption go through the floor in the US, and obviously one of the big points you've been making in your rounds in the Australian media is that when it comes to Australian mortgages, Australians prioritise paying the mortgage. Now, it is fair to say that in some US states, they have the same mortgage laws as we do, where you can't just walk away from the mortgage. Even if you sell the property, you still have to meet the obligation of the mortgage, or even if you default, you still have to settle that mortgage. But there are in other states where they have non-recourse loans, they're able to hand over the keys and walk away and leave the bank with that problem. And no doubt, I think we're going to see some of that behaviour that happened during the GFC happen again in the United States.
Certainly possible. The jingle mail, of course, as it was called, was quite a feature of the global financial crisis. And it's just worth reflecting that there's been a significant run-up in house prices as well as the debt, right? And in fact, Powell in the press conference did actually say that he had a view that maybe house prices and the housing market needed to settle back to get supply and demand more in equilibrium, which to me was code saying he expects prices to slide back now.
Very, very interesting. Now, what does this all mean in terms of Australia? So obviously, the RBA thought that they were forced to raise interest rates at the last meeting by 0.5. One, to show Australians that they were serious about inflation, but also to keep pace with central banks around the world. So now that the Americans have gone 0.75, I think we're confident saying that the RBA will raise rates by 0.5% at least on the 5th of July. Potentially, they could go more than 0.5. It could go 65 or 75 basis points. And again, we're seeing an environment of in terms of rapid rate rises, given that we've got the second biggest household debt to GDP in the world, and for a lot of households across the country, that's again spelling disaster. But there's some person in Australia, Martin, who doesn't think it's a problem at all. No. And so this week we saw the RBA governor coming on the 7:30 report. And it's very rare that he actually gives a public interview like this on national TV, but obviously, given the rapid evolving situation, he thought that he should. And he was fairly upbeat about households and the economy and people being able to weather this storm. Now, before we go into specific comments, let's actually put slide 9 on the screen. And we have only in the last couple of days showing that ANZ Roy Morgan is showing that consumer confidence in Australia has fallen to levels not seen since the 1991 recession. The only time that we saw something like this was in a couple of years ago when we had the panic about the COVID-19 and in terms of the pandemic. But outside of the pandemic, now the funny thing about the pandemic is we have health officials and the Victorian Premier in particular saying that COVID is still a risk, and yet the RBA governor said the pandemic's over. And therefore, that's why we need to take away the stimulus, because we were in an emergency, the emergency's over. Well, you've got the economists saying the emergency is over, you've got the health officials saying that there's still an emergency, and across government, there's a completely inconsistent position about what about where we're going here. But obviously, a couple of key points, and we're going to come back in a future show about some of the more specific points the RBA governor said. But a couple of key points that he said was that we did 2 shows ago, we talked about in terms of the debt sheet being sacrificed. Well, he basically said he conceded that some people did sign a mortgage based on this forward statement or this communication that no rate rise between 2024. But he said those people who did, and some of those people are our audience, that he said those people didn't fully understand what the RBA was trying to say. And the RBA apparently said that there would be no rate rise if the economy evolves with our expectations. And obviously the economy has not evolved in 2022 consistent with their expectations, and that's why they're rising rates. So he basically said that, you know, if people read their statements carefully and looked for the caveat, they would have realized that it was a conditional statement. It wasn't a definitive statement or a political promise. And so he had no remorse over those people, even though he did concede some of these people have signed mortgages that if had they had full sense of knowledge of where we are today, they wouldn't have signed them. But he's going to raise rates because he said, I have to look at the big picture, and the marginal borrower or the debt sheep, they're going to be sacrificed. And he had, you know, not willing to accept any sense of responsibility or accountability for that. So those people who particularly borrowed on variable interest, perhaps over the last 6 months, you know, a good night Vienna, as you said previously.
Well, it is absolutely in line with what Ian McFarlane said the other week, right, in the AFR, that the marginal borrower is going to get run over by a bus, basically, and Lowe basically confirmed it. But I have to say, I think he's being very disingenuous to the Australian public.
So it's a very dark environment that we are now in. I mean, we are, particularly in certain parts of the global economy, it's already reached crisis point in the last 4 days. That's why they're surrendering to inflation, and that's why these problems are going to get worse in Japan and Europe. And obviously, we're going now into a situation where Australia, US, New Zealand, etc., will go into a recession, and I think the recession is going to come quite quickly. And then the question is, well, once we are in recession, do they pursue the inflation fight, or do they give up? And what does that mean in that environment? And I think for a lot of middle class families, it's going to be a very nasty couple of years coming.